Welcome to the REI Diamond Interview, your source for real estate investment jewels of wisdom with Dan Breslin.
Welcome to the REI Diamond Interview, part of the REI Diamonds newsletter. I'm Dan Breslin, and I'm here with a good friend and colleague of mine, Joe Scorese, on the line. Joe's going to be speaking at our upcoming Philadelphia Real Estate Investor Networking Group. If you want some more information about that, you can go to www.ringphilly.com and check that out. So thanks for coming on the call, Joe.
No problem, Dan.
So I want to start off by talking about a little bit about my experience with you, Joe. A lot of people are kind of like the 4-hour work week mentality. They are looking to do as little as possible and wall themselves off as much as possible and kind of hide behind the computer and systems and personal virtual assistants and things of that nature. Whereas you, like myself, I like to think of myself as being available for success, meaning like if I call, somebody shoots me a text on a Saturday at 7 o'clock and I see the text, I'm answering the text. If somebody gives me a call and I'm available to take the call, I pick the phone up and, take the call. And my experience with you, Joe, in the, 7 or 8 years that we've been connected has been you've always been available to success. And I imagine that's the same way you are with your clients. Is that true?
I appreciate those kind words and 100% true. Accessibility, follow up and follow through, consistency and continuity in the business is very important for success.
Go ahead.
I can't emphasize it enough. It's always refreshing when the client goes, wow, you called me right back. And you're like, really? And you're like, wow, that's what you're supposed to do. You're saying that to yourself.
Right.
But the clients are very appreciative of that. Even with the bad news or good news, you got to give it quick. So if it's bad news, this thing is not as bad.
Yeah, you got to get the information back and forth, even when it's bad news. So, Joe, for those that are listening that don't know who you are, tell us a little bit about yourself, your business model, what you do for people.
Well, my name is Joe Scorese. I'm with Monument Bank. We're a regional community bank. We offer residential and commercial mortgages, as well as construction, development, multifamily, commercial mixed-use loans. We do enjoy the greater Philadelphia market and South Jersey market. We are licensed, though, nationwide, so I am allowed to conduct residential financing in all 50 states. My background is also accounting and networking and marketing. Really, my belief is your network is your net worth. So I help assist some great real estate investor associations in the area in coordinating some of the subgroups that they offer to different real estate investors and industry professionals to educate them on different pieces of the pie in the real estate industry. So it's a great way to then attract the right circle of influence or the right power team for yourself and the type of client that you want to work with.
Speaking of the type of clients you want to work with, who are the best clients you are able to serve, Joe? Who would be your ideal, person who should contact you?
Well, it's a great question because, from a construction, renovation, rehab, and flipping perspective, really the ultimately perfect client for me is typically somebody that has a 680 credit score or better, has reserves, maybe a savings and retirement accounts so they have accessibility to cash. Maybe it doesn't have to have a lot of experience, but has to have the proper credit and financials and income to support a transaction that they're trying to jump into, whether it's a renovation, cash flow hold, or a renovation and flip type of opportunity.
So we're talking single family investors, new construction investors. What do you think will be the sweet spot there? People just getting started, guys who have 40, 50 properties and are looking to get another 40, 50. Experience-wise, what do you say you're best able to serve them?
Well, I've been able to serve all of those depending on their portfolio. If somebody has 30 or 40 properties, it's definitely a portfolio loan. It's not a Fannie Mae regular residential loan where you're just doing another refinance for them. There's a lot of things have obviously changed since the mortgage collapse in 2008. So for the person has that 1 or 2 or 3 properties, I'm very involved in the residential side to properly mortgage plan their portfolio out as they grow, almost like a mortgage financial modeler. I model the direction to allow them to grow correctly and not become unbankable or lack of reserves for future acquisition or refinancing.
Say that one more time, a mortgage financial modeler?
Correct.
So you're able to kind of come up with...
Yeah, you're modeling a portfolio and trying to get them from, say they have their primary and one or two other properties. You want to take them to the portfolio of 10 properties or build them out 5 or 6 properties and allow them to start looking into multifamily properties or commercial properties, construction development opportunities.
So although you probably can't necessarily market yourself that way, you're like a real estate financial advisor in a sense, right?
Correct. Advisor, modeling in a sense of helping them build out their portfolio, evaluating their financial resume the way it is now and where we can take it. I'm always sitting down with clients saying, hey, listen, I own X amount of properties and I want to get to a certain amount of revenue stream in the next 12 or 24 months. I sit down and evaluate what they have in reserves, what they can take on in a proper manner where they can get to their goals or meet their goals in a certain amount of time, because they're trying to substitute potentially W-2 income, where if they might be retiring, then they're now going to live off of that income eventually as a residual. So I sit down with clients a little more often now than ever and evaluating their tax returns, evaluating their future capabilities.
Strong. So the experience is not necessary then. Somebody who's just getting started and has some reserves in the FICOs is good to reach out to you, correct?
Well, and that's a great time because they're unscathed. They didn't make a lot of mistakes yet. They're just dipping their toe in the water, and I could help them the best because I could almost say, listen, this is the right direction to go to build out some landlord experience, to build out some experience in renovation and construction. I could help them grow right from the get-go. So the inexperienced sometimes, the people that are just starting out are just as good as the person that has 5 to 10 properties and that has a lot more experience.
Nice. And I think it would be pretty powerful if people understand, I guess, how did you get to where you're at today? Like maybe, your first couple deals, do you own property? What would give you the experience level that you could see the best course of action for, a newer investor getting started?
Well, I started very early. I went and got my real estate licenses when I was 18, so that was in 1987. So I'm licensed in New Jersey and PA as a real estate agent. They're both in referral, which is fine. And I start really just going after properties, not really going to a lot of classes and workshops. And of course I made mistakes like other people, but I was able to buy correctly where I felt comfortable enough that there was be enough equity on the back end. And I really didn't understand cash flow and maximum level offer and after repair value and all these other little intricate things. It was just a lot of common sense moves. So I built up a nice little portfolio for myself up in the North Jersey area as well as up in the Lehigh Valley area. And over time, I made some mistakes, lost some money here, but made some money here. It worked itself through. So now I have a nice residual coming in for some multifamily and commercial properties I own with family. And now I'm also renovating, rehabbing, and flipping properties and or new construction here in the Philadelphia market as well as South Jersey. So it's been over a gradual 20 years of, watching the market, losing, again, in 2008, a lot of people lost money. We all kind of had to take a 2-step back to go a couple steps forward. And, but in the past 24 months to 36 months, it's been a great market for investors to jump in. And I've been as transactional as some of my clients.
You say you're as transactional. You're doing how many fix and flips per quarter, per year?
Probably averaging anywhere between 2 and 3 flips transactions per quarter and flipping the properties. I also recently opened up a property management company to facilitate not just my own portfolio, but really be able to help a lot of the investors that go through the same type of frustrations that I go through. So I'm really offering as much assistance to my client as possible. So I co-own a property management company which assists a lot of these investors once they take on some of these properties.
So did you start off self-managing and then transition to management, or did you always use management companies and then just decide to create your own to kind of leverage up your strengths?
Well, at first I felt that I needed to self-manage, and I learned a lot. I learned that I really need to allow management to come in place because self-managing the properties did not help me grow. And really having a couple of the professionals in your corner helping you understand all the processes and make sure things are being paid, all the bills, you don't want to run behind on anything, is a huge help. I can't even go into how much detail, how important it is to have somebody help you make sure you're making sure all your bills are paid. And a management company does.
Do you think there's a certain number? Say a guy just wants to have 3-4 properties and maybe that's all he's going to have. Should he be self-managing, or is there like a tipping point where, if you reach 10, then you should turn it over to a management company?
I think, at a point, if somebody's W-2 income and they're working a full-time job, I really feel that if they're going to grow accordingly, they need to position themselves with a good property management company from the get-go. They're going to have to oversee that property manager. I mean, you're babysitting the babysitter, okay? But it's giving you a good opportunity of seeing what they're doing and how they're operating, but it's also alleviating a certain percentage of time so you could then conduct more due diligence on acquiring additional properties and building your property portfolio accordingly, not scattered. You know what I mean?
Yeah, I do. What would you say would be the task? I mean, you can give us like a quick synopsis of how to oversee your property manager or maybe choose the property management company. What would that look like?
Well, there's definitely an accountability that has to come into place. What is the property management going to provide you on a month-to-month basis? When are they, what are the services that they're offering to you to succeed and show a proper cash flow on your property? I'll use a great example. I have a client, a personal client, who now the company that I co-own and manages his portfolio. When I evaluated his portfolio based on the income and the numbers, the property management fees, and everything about his 30 properties, we found out that he was losing money on 4 of them, $1,000 a month. And he did not realize that he did not realize that until I put together a spreadsheet really highlighting his schedule of real estate owns and breaking down taxes, insurance, property management fee, deferred maintenance, the things that were costing on a month-to-month basis. He was losing money on 4 properties, but because he was making money on a gross level from all the properties, the management company was able to hide that loss, and blend it within the portfolio, where here he knew exactly which properties were making money, which properties he was losing money, which properties he was breaking even. He had to raise his rents. He was actually charging too little. And the only person that was really making money in that relationship was the property management company. And since then,
they weren't doing a great job, I guess, either, because the rents were too low, right?
Correct. And from a financing perspective, I was able to fix it and be able to refinance some of the properties where he was able to better cash flow on the properties and move forward and has acquired since then another 6 properties.
Nice. Joe, if you could give us a few, you said you should see what services the property management company offers. What would be a few examples of the services that should be expected from property management?
Bookkeeping, accounting, and collection of the rents. Proper eviction notifications and eviction proceedings on behalf of the landlord. Inspections, a quarterly inspection on the property. Pictures, doing a pre-audit on the property prior to taking on the property. Very important. Understanding what the taxes are, what the insurance is, what the current collection of the rent is, what's the condition of the mechanics of the property. All that is preliminary evaluation and audit prior to taking on a property. A lot of management companies take on accounts sight unseen. A good property management company is going to do a complete inspection of the property prior to taking on into their portfolio. Also, having a month communication via email or call with an update to the property once an invoice is sent out or an update, a statement is sent out to the client. So make sure your property management company has a good software in place that can handle that translation. And then obviously the management company has to have a timely maintenance company that handles any of the maintenance calls. Also, having the snow removal is extremely important for the properties if it's needed, things of that nature.
Nice. I'm going to switch the topic back. You mentioned that you were buying 2 to 3 transactions to flip each quarter or so. And that's pretty good pace. I know, because that's a business that I am in, and I know that the question that's probably burning in everybody's mind right now is, where do you find these good investment properties, especially the fix and flips, Joe?
To me, you need to be out there networking with as many people as possible. Not just realtors, CPAs, financial planners, big industry to go after and get friendly with. Estate attorneys. I can't tell you how many very successful professional real estate investors have 2 or 3 real estate estate attorneys in their pocket, where the attorney is just calling their client, calling the investor saying, listen, do you want to buy this property? The aunt just passed away and their kids want to get rid of the property. It doesn't even hit the market. So it's not about just having good relationships with realtors, loan officers, all the other spectrums, wholesalers for that matter. The other professional services are out there. You need to meet them at various networking events, connecting with them on various business social sites, etc. You need to be as well-rounded to find those opportunities. I can't tell you how many calls I get just on properties that are not even on the market, just directly to me. Hey, Joe, do you know anybody who would be interested in buying this property? And they're not realtors. That's what you have to build the right opportunities.
Of all the properties that you bought, how often or what percentage would be brought to you by real estate agents or listed on the MLS that you can actually flip, Joe?
Right now, I'm probably seeing, based on what I'm currently working on, 60 to 70% off-market properties that came to me comparatively to a 30 or 40% of a realtor presenting the property to me that was potentially on the MLS at any time.
And 60 to 70% is coming as a result of your consistent. Yep. So I guess you help some of your clients find deals also. Is that kind of part of your service for clients, Joe?
Well, if a client is in need of mentoring, I will be able to help, them identify a property that would match up with their financial resume. And that's something I've done, which has created a good reputation for myself in the business, that sometimes I just come out, meet with the client, and evaluate the property. And, yes, there's an opportunity for me to finance that property and successfully be paid upon finding that property, but the client really appreciates that extra step. So I will help them once I get them financially approved for financing, whether it's construction or conventional financing. I will help them if they need it in identifying a real estate opportunity.
Does that include fix and flip properties for clients? If a client has cash and nice.
Yeah.
What's to keep you and your team from keeping all the good ones for yourself and just giving them the duds, Joe?
You know what I tell people, that there's always another great opportunity. So, me putting a good opportunity for one of my clients is going to help me 3 times forward. It's amazing. I identified a property for a client in the Philadelphia market, and 5 days later, one of the people on the block recognized me saying, "Hey, you're the one that put that property together to get it fixed and renovated. Hey, I have a friend down here that wants to get rid of another property that's not on the market. They're scared of real estate agents," and I was able to obtain that property as well. So I kept that one for myself because it came to me. And I could have handed it off to another client, but, there's only so many properties you could take on and successfully turn them around. So I'm very careful on how much of a load I want to take on of inventory to turn it around and flip it or refinance and cash flow the property.
That's about the same that we got, the situation, because I'll find 10, 12 off-market deals per month, and I do offer a lot of those out to my client base, and I get the same question: what's to keep you from, keeping the good ones and then just giving us the duds? And really, it's the same thing. I'm amazed at how small our capacity is sometimes to complete renovations and finance those renovations. $1 million in capital will be tied up quick in, 4, 5, 6 properties. And then our cycle is like a 6-month cycle. So, during that 6 months, my off-market deal machine keeps on producing. Cool.
And as you know, there's always another great deal, Dan. There's always another one. There's always a property that goes into distressed circumstances. I was recently up in the Rittenhouse Square area, and there's 2 properties that were bought in foreclosure, and one of them needs complete rehab in Rittenhouse Square, the wealthiest area of Philadelphia. So there's a deal everywhere, in every neighborhood. It doesn't have to be only the lower end neighborhoods that might have, blighted properties, a multiple amount of blighted properties. It could be in the nicest area in the whole city.
Did you guys buy that one, Joe?
No, I really didn't feel comfortable with the numbers, but someone's going to buy that. They had people going through it while I was going through, and that's fine. It might work for somebody else. It just might not work for me or one of my clients. And that's why I take the extra step. I go preview properties and see if it makes any sense.
Nice. So if I'm a client thinking about, coming to see you and getting started, why do I need you, and how much are your fees, Joe?
Well, I don't charge any fees to put together a financial resume and get somebody approved. I'm a licensed banker. So my job is to get you bankable money where there isn't as much a charge or fee. Your fees or charges are on the HUD that are title, legal, a lot of third-party fees. Me as a banker, I'm not charging you anything to get you qualified. So my job is to get you prepped and ready. I get paid at closing based on the loan closing. Okay, so there's a lot of broker bankers out there that have to get paid maybe a fee. I am not allowed to accept a fee for my services like that. So that, again, it's usually a great relationship synergy where people feel, I don't have to pay you up front for anything. I said, no, this is what my job is. I qualify you for acquisition or refinance or rehab, and there's no fee.
Makes sense. What about, again, we'll go with the new guy just getting started. Should I flip or hold properties, Joe?
And again, it really depends on their capital reserves. Do they have enough reserves to carry debt on a rehab property? So that's based on the original application that I take and put together, and I would determine what would be necessary. If they have $1,000 in their account and they have an 800 score and they have a job, but they have no other money, that's not somebody that can carry the costs during a rehab, correct? So they would need to find either a partner that has cash or be able to borrow money from a family member or friend to be able to show proper reserves to acquire a property.
Got it. So it depends on the situation. I mean, everybody I run into wants to flip houses. They're watching TV and they just want to, make 50 grand on a flip, and it is a little more complex, and the profits are often a little smaller than what we see on TV. But financing a rehab property, Joe, are there special products out for that? Do you kind of have hard money lenders? Nationwide, if somebody wanted to flip a property and they wanted to come talk with you, is that something you can help them with?
Absolutely. I mean, it really boils down to how they're buying the property. If they're buying a property that's at 65% or under loan to value based on the completed value, I can find them and qualify them for construction financing, or what you might call hard money, because the rate is a little higher, obviously, than conventional rate, which makes it harder numbers to look at. So that's where the term hard money came up with back when it originally started being placed out there and being marketed. And the reason why you're paying higher money, because you're getting almost the entire portion of the construction to rehabilitate a property and stabilize the property to be livable and functional. So, the going market across the country is around 65% loan to value all in, meaning purchase and rehab based on the completed value. And that's where I come in and help qualify that client, whether it's here in the Philadelphia market or it's in the Maryland market, it's in the St. Louis market or a Florida market. It doesn't really matter to me. The numbers have to justify themselves, and they have to do due diligence to verify the maximum allowable offer to purchase that property, plus figuring out what the after repair value of that property is. And that's where I come in to help them qualify.
What type of interest rates are you seeing on hard money loans and construction loans and things of that nature?
The rates I'm seeing start off at around 9%, up as high as 14%, and range between 3 and 5 points on average. But again, it's the cost is only relative to your profit and your equity built in when you're buying at closing. You make money at closing. So if you're buying something all in at 60% loan to value and based on the completed value, and you're paying 15% cost on your money, and you're going to turn that property around in 4 or 5 months, doesn't sound like a lot of money that you're spending to get it done quick, close in 2 weeks, and turn the property around and make yourself an extra 40, 50, 60, 100 grand.
Makes sense.
Absolutely.
What about real estate seminars? You said you started off your career and you kind of learned through experience. I mean, if you had it to do all over again, would you have sought out some of the real estate seminars and maybe got, a little bit of a shortcut there in the beginning?
I would have definitely invested my money into real estate investors associations or workshops that tie into either landlord associations, homeowners associations, accredited organizations that would have helped me build out my power team sooner and give me a lot more inner knowledge on the intricacies of acquiring a property, rehabbing a property, and all the things that fall in between landlording. Right in this local area, we have the Homeowners Association of Philadelphia, which is HABCO, and we have the Diversified Investors Group, which covers the greater Philadelphia market. Both are not-for-profit, basically, organizations that help educate and facilitate services for landlords and investors in the greater Philadelphia market. And the membership for DIG alone is only $150. I think the membership to HABCO is only $150 or $135 for that matter. So that's extremely cost benefit to expand your education and accessibilities to professional services, and not spending a lot of money there and focusing on spending your money on acquiring real estate.
Maybe you'd be able to verify this rumor, but I heard that the HABCO organization has a book that's basically like the guide on the zoning office, the rental inspection requirement, everything you need to know about owning a rental property in Philadelphia. I'm told by one of the members of HABCO that that's going to be included coming up again as part of that membership, which is like aside from all the other benefits, this book. Have you heard about that, Joe?
Actually, I received the book as a member of HABCO. So any current members have received a copy of that book, and that's an additional benefit of being a member of HABCO, which I feel is invaluable. Just having that book alone, giving you the proper directions. We did review it at the membership committee. I'm on the membership committee for HABCO, and I felt it was a great book to send out to the association, and I think there's going to be a great appreciation of that amongst the membership.
Nice. And I'll add the links for each DIG and HABCO in the show notes here.
Absolutely.
So if you need to check them out, you can. So what do you think is the first step? I mean, you want to get started, kind of on the fence. You know, obviously, if you're new, you sort of know what you got going on. But what would be the first step for real estate investment, Joe?
Really find out what your capabilities are. Don't go out and try to look at $500,000 construction loan opportunities when you might only qualify for $250,000. Sure yourself up and find out what your true financial capabilities are. And you find out whether you can or cannot right away. Now, if you can't, you become a studying person, like a person that more studies real estate, so you're capable of taking down a real estate opportunity. I see so many people putting money out in the wrong directions without really making sure that they're qualified eventually to acquire an investment property. So it's really all about fixing whether it's your credit, your financials, your reserves. You really should shore that up in the first before you really go out there and go to all these events and spend additional monies without knowing what your capabilities are.
That makes sense. I mean, looking back at my own career, I started off by finding a couple deals. I mean, we're talking $5,500 house that I sold for $11,500. That was my first deal. And then I ended up, 3 or 4 months later, I bought my first flip for $20,000. We put $25,000 in work into it. So we're in for $50,000 altogether. And I think we sold it for $85,000. And now I'm about, our average retail value on the house is probably between $175,000 and $300,000, kind of our sweet spot now. So I think that's great advice to not run out there into Rittenhouse Square, the most premium section of the neighborhood, and then try to, flip that house thinking you're going to do this $1 million deal right out of the gate. I mean, absolutely, that's great advice.
And that goes for any capital market that you live in, whether it's New York, San Diego, Boston, St. Louis, Kansas City, Tampa, or Miami. You need to know what your capabilities are so you know what direction you need to go after the type of properties that are approvable for you.
So knowing what you know now, I mean, if you could go back and, take a different turn or start a different way, is there anything you could kind of like to change?
I probably would say I would wish I sat down with a property management company day one with my first property. I would have learned a lot more with being an understudy to a good property management company, putting some proper controls in place.
And this is on a personal note, or, could be something to do with the business, but what would be the greatest challenge you had to overcome, Joe?
My greatest challenge is really being involved with the last 3 real estate cycles we've had. Everybody says a real estate cycle is 10 years. We've actually had 3 every 5 years. We had a great move up, and then we had a recession. Then we had another move up, and then we're kind of flatlining, really getting to another mark. So being more of a chameleon, I would say, is really most important in adapting to the environment as the market shifts. And, the struggle was always maintaining proper credit, proper financials, proper reserves. That was always the struggle. Maintaining a consistent revenue stream to facilitate my goals and my vision. So it's a lot of hard work.
Through all the cycles. So that was ironic. You said that we're, coming off of a 5-year up cycle in your mind?
I really think the real estate cycles are every 5 years, not every 10 years. So we're coming into a somewhat strong spring market, but at the same time, the rates are moving up a little bit. So it's testing the market to see who's really wants to own a house, or who is really going to buy and renovate a home and flip it and put it back on the market for a buyer. We're coming into the second quarter, creeping toward the third, and the rates they're hanging tough, but they're moved up a lot. They've moved up 3/4 of a point probably in the past 2 quarters. That's quite a bit of a move, but still people are buying it. It's a very active market.
Do they actually move these interest rates to make an attempt at keeping our market flat so we don't see the repeat of the 2008 debacle here, Joe, in your opinion?
I really believe that the Feds are really taking an extra look all the time now at the rates, because they don't want us to go back into a recession, but they also don't want to give money away. I mean, people that locked in their rates at 3% or under, that rate really is not a real rate. They just lucked out based on the Fed was trying to stimulate the market, for people to put money back out on the street, invest, and things of that nature. But I mean, really, a rate in the 4s is still extremely cheap money. And I feel that's not even really the real rate of what the Fed should be allowing. I mean, the real rate out of the market should be around between 5 and 6%. We're still at 4%. So I think we're in a very good time to acquire a property if the rates do bump. But I really don't see the rates moving that much extreme during a run of a presidential over the next 24 months.
Yeah, I'm inclined to agree with you there. Now, point-wise, do you see any long-term fixed rate loans for portfolios. So somebody's got 10, 12, 15 properties in an LLC. They're going to do a portfolio loan. Is there a way to lock in these low rates for any longer than, say, a 5 or 10-year term, Joe?
There is, but it's usually a very small portfolio bank, and it's really region by region. Do I know of some small banks that do this that I work with? Yes. But a lot of it's case by case. They don't lend in all areas. They might only lend in certain designated areas. So you have to really do some due diligence from a smaller level. Like the larger banks are not doing those type of loans. The smaller banks, credit unions, or small portfolio banks are doing them. So you got to really do your research when you're out there if you're going to buy in certain areas and really understand your market. And that's any market. That's any area in the country.
Nice. So we have you coming out on May 13th to the Philadelphia Ring event. Do you want to give us a little synopsis of what you might talk about there, Joe? We're going to really go over the A to Z meat and potato of lending fundamentals, understanding the different areas of lending and where, the different types of criteria of real estate, and tie it back to some true make sense lending fundamental checklists and things that really are necessary to be a professional real estate investor. Now, is this just for beginners, or are you going to put in some stuff in there that the guy who's got 30 or 40 properties should come out and hear also?
I believe that somebody owns a 30 property portfolio to the person that's just starting out is going to walk away with a couple golden nuggets out of this presentation.
Nice. All right, we've come to the end of the interview here. Did you have anything else you'd like to add before we close, Joe?
I'd like to just thank you again for the opportunity of speaking on your show today, and look forward to working with you at the Ring HAPCO event May 13th.
I appreciate your time and your generosity with your knowledge, Joe. Likewise. So if anybody here does not already receive the REI Diamonds newsletter, you can go to www.reidiamonds.com. And as part of that newsletter, you will receive the interviews that we conducted, just like we conducted today. And on May 13th, we're going to have Joe out at the Ring meeting. If you're interested in coming out to that, this event is actually going to be free. You can get the details on that meeting at www.ringphilly.com. This is Dan Breslin, signing off.
Thanks for listening to the REI Diamond Interview. To receive the REI Diamonds newsletter and interview monthly, sign up now at www.reidiamonds.com.